As far as the Indian market is concerned, specifically, it's you can break it into two parts. One is, of course, the issues around what's happening globally. So what's happening in China, the volatility around China markets, or even the yuan or depreciation or the devaluation which they were planning to do, and added to that the recent comments by the Federal Reserve in terms of that they do not rule out a negative interest rate or even a zero interest rate. So these are the kind of comments which the markets were not really prepared for, and that's what's kind of impacting global markets. So whether it's sentiments around whether global growth will further slip down if even US economy is unable to really come out of the woods just yet, and so that's the first part. So what's happening in China, US, Europe, and Japan, and the interest rate scenario there, and the devaluation story which can play out. What's happening as far as India is concerned, in terms of what happens to the fiscal deficit numbers in the upcoming budget, or the expectations around the ongoing reforms process, which will it continue, and the earnings which haven't really come through. So we've been expecting an earnings revival for the past couple of quarters, but it's unable to come through for various aspects, whether it's the currency depreciation, whether it's a delay in the investment cycle recovery to the great extent, or just the general revival of the domestic demand because of poor monsoons. These are the aspects which are kind of impacting the overall market in the near term. So but having said that, just to put into perspective and to conclude, we personally believe that at least the steps taken by the government over the past 1.5 years is definitely a step in the right direction. We've clearly seen that 2015 was one of those years where it was extremely refreshing to see domestic investors coming and supporting the markets. Your foreign institutional investors poured in close to around $3.3 billion last year, net number, whereas the domestic investors poured in, the domestic institutional investors as it's called, they were up almost $10 billion, $10 to $11 billion. In other words, a lot of retail investor participation was visible in the markets. In 2016, however, that momentum has slowed down to an extent if you really look at from a year-on-year perspective. And just to give you a sense that the average net inflows for any given month last year was, let's assume it was 7,000 crores, it's now down to maybe close to 3,000 crores. So the momentum has come off. It's not reversed. So it's not that it's outflows yet, but if this trend continues, we've usually seen that investors do kind of lose patience, and then the buying intensity could reduce. What we would advise investors to do is that even if there is increased volatility in the markets, we would tell them to really increase their amount of SIPs they're investing into, because these are the times where even if where the future is not very certain, the SIP investment becomes the best strategy. That's without doubt. And the reason is that you are not then timing the market, you're not waiting for the market to really turn around. Even if the market kind of goes down because of global volatility, you're taking that as an advantage rather than waiting for the markets to rebound. Because what happens is that once you have invested consistently in the downturn, let's assume for the next 6 months the markets remain negative, or they remain challenged, and in those environments you've invested, your average is obviously going to be much lower. And when that economy turns around, which ideally we hope will happen, you will get the benefit of that. That's when I said that investors who are ready to take the risk right now may be rewarded maybe a year or 2 years down the line. What's spooking the world markets is the volatility around most of the asset classes, including commodities, because nobody is really is able to point a finger where this is going to stop. So even as far as India is concerned, is lower commodity prices good for India? Of course it is good, but a volatile commodity price is not good for India also. Even if it's 30 going to $50, then 50 again going to 30, that does not give you a sense in terms of pricing, in terms of the expectations or the planning the future over the next 2 to 3 years. So that's the way we look at the market right now. The biggest point is, however, earnings growth, which is missing across the globe. So it's not that India is the only country in the world where earnings growth is not coming through, but most of the world economies are struggling with the earnings growth kind of disappointing, and that's something which is also could be related to the energy price decline and the capex related to that, which has also gone down. So that's impacting the global earnings.